Hi, and welcome back. All right, we're going to get started with this big, beautiful bill series. And the first life stage I want to focus on is those that are just getting started. So this could be kids in high school, kids in college, kids just getting their first job. I want to focus on mainly the single kids that don't have a family yet, don't have kids, and what this bill really means to you. But it can also be important for parents to know what some of the benefits and some of the drawbacks of this bill are for their kids. So again, although this episode might not be applicable to, say, somebody that's already retired, it may be applicable to that person's grandkids. So there's a strong tie between these generations and what this bill means to everybody. So let's get started. For those of you just getting started, first and foremost, the big beautiful bill locks in the existing marginal tax rates. So if the bill would have not happened, the first Trump era tax rates that had been lowered would have all reset and gone back higher. So that's a benefit that, quite frankly, benefits all of us. The other point I want to make, a good point, is that the standard deduction increases. As somebody that's young, you probably don't have enough deductions to itemize when you file your tax return. So you just take the standard deduction. Well, the good news is that that deduction goes up by approximately $750 this year, $15,750. So these next few topics I want to get into will probably have gotten the most attention. And the first one is tips. So let me share my screen. And so when it comes to tips, this deduction, it's limited by your tax bracket. So if you're, in this example, if you're Karen and you're in the 12% tax bracket and you earn $8,000 in qualifying tips, then your deduction comes out to $960. I think the media, the administration wants to make a really big deal about tips and overtime deductions, but when you peel back the layers and you look at the amount of the deduction, while it's not nothing, it's not as significant as what I think it's being played out. So the cap on these tips is $8,000. So if you make more than $8,000 tips, that's your cap. You can't, if you earn $10,000 in tips, you're not going to get, in this example, a tax break of $1,200. It's capped at that amount. The other thing that still applies is payroll taxes. Payroll taxes, if you recall, 7.65% no matter what. Also, state taxes still apply. We're just talking about a federal tax deduction. With all of these deductions, whether it's tips or overtime, and doesn't really matter what life stage you're in, they all have income limitations and phase outs. So what do I mean by that? So as I'm pointing out here, those that have a modified adjusted income over $150,000 if you're single, or $300,000 if you're filing joint. So for every $1,000 that you're over that threshold, so say you're single and you make $102,000, you're over that threshold by $2,000. So for every 1,000 you're over, your deduction drops by 100. So an example would be, in that case, rather than getting if you're in the 12%, will actually be higher than the 12% tax bracket. But if you take your tax bracket, multiply it by your tips, and if that number's $8,000, it's $960 in this example, you're over that threshold, then you take $200 off. So your deduction then becomes $760. My point is, the more you make, the less you're likely going to get from this deduction. The other thing that really matters with this is that these are tips that are reported. Believe me, when I was in high school, college, I was a bartender, waiter, and sometimes you just don't always claim your tips, right? This deduction is only on what's being reported. So if you get cash tips kind of like under the table, if you will, those don't count. It's only what's being reported. So that's the tips deduction. All right, let's move on to overtime. So again, overtime, there's a qualifying cap as well at $12,500 for singles, $1,000 for married couples. And as I'm pointing out here, and you'll see this throughout this big, beautiful bill, is that some deductions only apply for specific years. So for this overtime deduction, it's only for 25 through 2028. Again, payroll taxes still apply, the 7.65%. And if you live in a state that has state income tax, those still apply too. It's only federal income tax. Another key with this deduction is that it's limited to your premium pay only. So in this example, if your regular rate is $20 an hour and your overtime rate is $30 an hour, it's only the $10 difference between the two that is deductible. So that's a big deal too. So with this tips and this overtime, there's so many nuances. And this is where I made the point in the beginning that while this all sounds well and good, it can get very complicated. Whether you're doing your taxes on your own, having somebody file them for you, what I want to get across with this series by each life stage is to arm you with enough information that if you're working with a professional such as myself, you could come, have a conversation, bring these things up, talk about your life stage, and see where we can get the most bang for your buck. So another hot deduction topic has been this vehicle interest deduction. So in this example, let's say Nick, who's in the 12% bracket, pays $4,000 in qualified car loan interest. So he's only going to save $480. Again, not nothing, but not life-changing either. So again, the federal tax bracket that you're in is going to drive how much your deduction is. Now, here are some caveats. And this is the first major hurdle, is Maria buys a used car paying $1,500 in interest, no deduction. This is on new cars only. The second piece, Chris buys a new car assembled in Germany, pays $2,000 in interest, still no deduction. Why? Because it has to be a new car that's assembled here in the US. And again, there's income limitations on this. So as I mentioned with the previous deduction with overtime, that was $150,000 for singles. Well, now this deduction, the phase out begins at $100,000 or $200,000 for joint filers. And it gets reduced at 20% for every dollar over that threshold. So say your adjusted gross income is $101,000, then 1,000 times 20%, $20 is off of that deduction. Again, with vehicle interest, it's important to know it's got to be can't be used, can't be new, made outside the country. It's got to be a new vehicle made or assembled in the U.S. And there's just another example I wanted to throw out to you. So with each of these series, I'm putting together a one-pager with my notes and some examples. So if you're trying to take notes while you're listening to me, feel free to email me, but I'll also put these one-pagers in our show notes. And of course, we're on YouTube and LinkedIn. You can follow us there, and all this information will be posted on there as well. So what I've covered so far, I would say, are the pros or the benefits of the bill. So what are some of the downsides to the big beautiful bill for those starting out? I think first and foremost is student loans. And one of the reasons why is that the borrowing limits are tightening up, meaning they're capping the amount of loans that you can get, not only for undergrad, but for grad school as well. And they're kind of making borrowing more expensive and repayment flexibility lower. So without going into the details of all the nuances of that, just know that when it comes to loan repayments, it can be based on your income, and those thresholds can be pretty high or they can be somewhat in the middle. But this idea of being able to defer payments long term is gone. The other, I think, key part of the bill that affects anybody that's either looking for a new home or trying to improve their home's efficiency, a lot of the home energy credits have been rolled back as well. So if you're just starting out, this may not be applicable to you because you may be renting. But for those looking at buying a starter home, fixing things up, there used to be quite a few home improvement credits that you could get, energy efficiency credits that you can get. Those are all being phased out. The other big green deduction, if you will, is for EV credits. It used to be that if you bought an electric vehicle, you may be eligible up to for a $7,500 credit. Well, that's got a lot of attention because that's getting phased out by the end of this year. So those are some of the downsides that may affect those just starting out in this phase. So what are the planning options or actions that you can take? So let me go back to sharing my screen and covering some of these. So the first one, as I just kind of talked about with loans, you want to prioritize your student loans. And what I mean by prioritize is making sure that they are at the federal level, that you're paying off your private loans first. And part of this is, we won't get into it at this point, but loan forgiveness. It's still up in the air whether that loan forgiveness program will continue on. I know for a lot of people, it's been very difficult to go through loan forgiveness process. But you want to make sure that when you're consolidating your federal loans, you're not resetting the clock on some of those repayment or loan forgiveness programs that are out there. Second is to just start saving early. I probably should have put a slide in here about the power of compounding, but hopefully everybody is somewhat aware that the earlier you start saving, the more time you have, the better your chances are to hit your financial objectives, whether it's saving for a new house, saving for retirement, whatever your lifestyle financial planning objectives are, the sooner you start saving, the better off you'll be. Second, or third, I should say, is to build up that emergency fund. I actually talk about this no matter what life stage that you're in, is making sure that you have some kind of backup plan if you lose your job or have an unforeseen bill that comes up. And a lot of times you'll hear this, well, rule of thumb of having 3 to 6 months of savings as an emergency fund. It's really dependent on each person and their comfort level, but it also depends on your job. For example, if you're a W-2 salary employee and you get paid every month, every 2 weeks like clockwork, and there's not a whole lot of there's very little or no variability in your pay, then that rule of thumb kind of makes sense. But if you're in, say, like a sales position, or part of your salary can vary quite a bit, then I've actually recommended that people have a bigger cushion because you're at more of a whim in salary fluctuations than if you just had a steady income. Fourth, and this is one I can really empathize with all of you starting out, this rent versus buy decision. Home affordability is incredibly unfavorable right now. Interest rates are high, home prices are high. It doesn't make it easy for people starting out to buy a first home. And I remember what that was like, gosh, almost 24, 23 years ago. But I would also say when you're trying to make this decision, think about the flexibility that, say, renting offers you versus buying. And a lot of times you'll hear like, well, if I'm renting, I feel like I'm just throwing money away. But remember, having and owning a house isn't all it's cracked up to be either. There's a water heater that'll bust, a dishwasher that'll go out. There's all sorts of things that you don't think about when it comes to home ownership that are expenses that you just may not think of, where you don't have that if you're renting. But renting gives you that flexibility. It allows you to be able to basically choose where you want to live or potentially relocate very quickly, as opposed to if you had a house and was at the whims of being able to sell your house potentially in a down market. The last one I want to point out is that there's a new universal charitable deduction, which could impact all of you starting out as well. And what I mean by this is that typically if you're taking the standard deduction and you made charitable contributions, you weren't able to deduct those. Well, now you are. And so for a single person, I think that deduction, whether you itemize or not, you can deduct up to $1,500 in charitable contributions on your return. And that's even if you just take the standard deduction. So with that said, again, if you have any questions about any of the information that I've covered, don't hesitate to reach out. You can find us at tammacapital.com, our YouTube channel. I'm also active on LinkedIn as well. With that, we'll move on to the next stage of life. Talk to you soon.